Good morning, everyone. So, your last session on financial reporting, I suppose, and the last session on analysis of financial statements, as well as my last session before seeing all of you as members of the institute. Okay. So, good morning, Shailesh. Good morning, Satish. Good morning, everyone. So let us start. Last time we had done a couple of case studies on analysis of financial statements. So today we shall continue the same. Yeah. So I have about 3 to 4 case studies questions which are there, which we'll go through. And then anything, nothing is majorly pending from my side. So once those few case studies are done, I'm done for the day. If you have any queries, we can then discuss and wrap up the session. Okay. So with that, let us come to question number 5. Test your knowledge. Okay. So I think this is one important case study, which is another full-fledged case study like the one we did in the last class. Okay. So let us start. Good morning, Tanisha. Good morning, Prashant. Good morning. So let us start with question number 5. Test your knowledge. Master Creator Private Limited, a subsidiary of a listed company, is an Indian company to whom Ind AS are applicable. Even if this is not given, it is understood that Ind AS would be applicable because it is a subsidiary of a listed company, and listed companies Ind AS are applicable mandatorily. So this being a subsidiary of that, Ind AS would automatically be applicable. All right. Following draft balance sheet is prepared by the accountant for the year ending 31st March 20X2. So you are having the balance sheet. It starts from assets. So this is an Ind AS balance sheet. So property, plant and equipment, financial assets, other financial assets, other non-current assets, you have capital advances, deferred tax assets. Current assets, you are having trade receivables, inventories, financial assets, you have investments, other financial assets, cash and cash equivalents. They have shown this separately, whereas actually it is a part of financial assets. Coming to equity and liabilities, we have equity share capital. In non-current liabilities, you have other equity, which is again incorrect. This should go as part of equity and liabilities. Deferred tax liability, again, they have shown it separately. We'll check if any note is there for both of them. Borrowings, long-term provisions, current liabilities, you are having financial liabilities, in that other financial liabilities, trade payables and current tax liabilities, giving you total equity and liabilities. Additional information, on 1st April 20X1, 8% convertible loan with a nominal value of 64 lakhs, nominal means face value of 64 lakhs, was issued by the entity. It is redeemable on 31st March X5 also at par. So the life of the convertible loan is 4 years. Alternatively, it may be converted into equity shares on the basis of 100 new shares for each rupees 200 worth of the loan. An equivalent loan without the conversion option would have carried interest at 10%. Interest of 5,12,000 has already been paid and has been included as a finance cost. Present value rates are as follows. So year 1, 2, 3, 4, you are given the rates at 8% as well as 10%. So in respect of borrowings, we are having adjustment 1. Okay. All right. So now, are we treating the convertible loan correctly in the financial statements in accordance with Ind AS 109, or is it incorrect? Is the treatment correct or is it incorrect? Good morning, Namrata. Good morning, Shruti. Good morning. Yeah. Tell me, come on, quick. Is it correct? If it is not correct, can somebody tell me the borrowing should appear at what value? If it is not correct, can somebody tell me borrowings should appear at what value? Don't look at the answer in the study module, please. Good morning, Viraj. All right. So this is question number 5. Okay. Adjustment 1, borrowings. Okay. So now convertible loan at fair value is equal to, how do I calculate this? This will be 64 lakhs is the nominal value. Rate of interest thereon is 8%. So this is the annual outflow. This I will have to multiply it with present value annuity factor of 10% for 4 years. Plus this is redeemable. So 64 lakhs into, they have said redeemable at par. They have said redeemable at par. So 64 lakhs into 0.68. Present value factor 10% year 4. Okay. So my question was, what should be the correct value at which this loan should appear? What should be the correct value at which this loan should appear? So obviously it will be based on the fair value. We have to do a fair valuation. So for the fair valuation, we are given the corresponding expected interest rate of 10% in respect of a similar non-convertible instrument. So let us take that. So present value 10%, 4 years, they have already given the rates to you. This comes to 3.17. So into 3.17 and this is 0.68. So you can check this. So if I work this out, that is right, it comes to 59,75,040. So fair value of the loan, that is the liability component, is 59,75,040. Okay. Convertible loan at fair value, I should have written it, that is fair value of financial liability. Okay. Fair value of financial liability. So I have 64 lakhs as the proceeds of convertible loan. Out of this, my financial liability is 59,75,040. So the equity component in this comes to 4,25,960. 4,25,960. This is a balancing figure. This should appear as 425 or 424. Sorry, 424. 4,24,960. Okay. Are we clear with this, everyone? Anybody has any doubts? Tanisha, did you follow? Namrata, did you follow? Viraj, Prashant, Shailesh has given the answer anyway. Satish also has given. So this is your answer. Okay. Yes. Anybody has any doubt so far? Okay, fine. So now what they are showing the borrowings at? They are showing the borrowings at the face value of 64 lakhs. Is this right? No, this is not right. So therefore, rectification entry. Borrowings at 64 lakhs, I will have to remove that. 2, financial liability 59,75,040. 2, equity 4 lakh 24,960. 4 lakh 24,960. Anybody has any doubts here? No doubts. This is on 1st April 20x1. We are preparing the balance sheet at which date? At 31st March 20x2. That means 1 year's interest would come. Yes or no? So, what they have told in the question is, an equivalent loan without conversion option would have carried interest at 10%. Interest of 5,12,000 has already been paid and included as a finance cost. Interest has already been paid and included as a finance cost. That means, what is this 5,12,000? This is nothing but 64 lakh into 8% if you do, you will get 5,12,000. Can I take this as the finance cost? Answer is no, because this is based on the nominal value and the coupon rate, whereas actually it should be based on the fair value of the liability at the effective interest rate of 10%. So my fair value of the financial liability is 59,75,040. So 10% of that should be your finance cost, but you have taken it at 5,12,000. So we have to make that adjustment. Are we clear with this? Yes, are we clear? Anybody has any doubts? No doubts? Yeah? Yes? Shall we proceed? Okay. So we will have to show the borrowings with this interest component of 5975 for 040 into 10%. Okay, so let me just prepare the amortization table in brief. Opening, effective interest rate at 10%, coupon, and closing. So we started off with 59,75,040. 10% interest will mean 5,97,504. You have paid 5,12,000. So the closing balance of your borrowing will be 59,75,040 plus 5,97,000 minus 5,12,000. So 60,60,544. 60,60,544. So this is your amortization table. So your finance cost should be 5,97,504. Whereas what you have done is you have taken 5,12,000 as your finance cost and repaid it. Okay, you have taken 5,12,000 as your finance cost and paid it off. Is it okay? So, fine. Incorrect entry that is already past is finance cost debit to bank 5,12,000. Whereas what you should have done is finance cost debit 597,504 to financial liability 597,504. This is one. And second entry would be financial liability debit to bank 5 lakh 12,000. Are we clear with this? Yes, are we clear? So therefore, what will be your rectification entry? Can somebody help me with the rectification entry? Finance cost debit 597,504 minus 5,12,000, 85,504. All right, to financial liability. Are we clear with this? Yes. Are we clear with this entry? Yes. Are we clear with this entry? Good morning, Mohammed. Good morning. Yes, Tanisha, good. Anybody has any doubts here? Anybody has any doubts, any clarifications required? All right. So finance cost will go up by 85,504. Financial liability will go up by 85,504. Finance cost essentially means this is the P&L because we have the balance sheet. So your reserves will go down by 85,504. Okay. All right. Fine. So coming to your coming to your question, you can see borrowings plus 85. This will be 59,75,040 plus 85,504. Coming to other equity, we have to change the position obviously, but adjustment 1 plus the equity component 424,960 minus 85,504. That is the additional finance cost that is hitting the profit and loss account. Are we clear with this? Yes. Are we clear? Okay. Okay. So coming to the next adjustment, note adjustment 2. After the reporting period, the board of directors have recommended a dividend of 50,000 for the year ending 31st March 20X1. Recommended dividend of 50,000 for the year ended 31st March X1. The same has not been accounted by the company in its financials. Anything we need to do, or we can just ignore this? What do I need to do here? Dividend has not yet been accounted. No need to account for it because this is only a dividend that is recommended. Nothing has been paid. And therefore, when will it be accounted? Only when the shareholders approve it. Only when the shareholders approve it. So this is only disclosure, no accounting impact. Okay. So that's it. Coming to the next one, other current financial liabilities consist of the following. Wages payable, is it a financial liability? Yes, it is an obligation to deliver cash. So this is a financial liability. Salary payable, is it a financial liability? Yes, an obligation to deliver cash. Coming to the next one, TDS payable, is it a financial liability? No, sir, but it is an obligation to deliver cash. Yes, but it is under a statutory requirement, not under a contractual obligation. So this is other current liabilities. And interest accrued on trade payables represents an obligation to deliver cash. So this will be a financial liability. So coming to other current financial liabilities, adjustment 3 now. Yeah. So this one we need to split it between financial liabilities 119,299, other current liabilities 81,265. Okay, fair enough. Coming to the next one, property, plant, and equipment. Okay, so this is adjustment 4. PPE consists of the following items. PPE consists of the following items. Building 3750-250, it is held for administrative purposes. So this is going to be categorized as PPE. Land 1548-150, it is held for capital appreciation. It will be investment property. It cannot be PPE. Vehicles 1237-500, these are used as conveyance for employees, no matter what, it will be regarded as a PPE. Factory premises 20 lakh 1,600. Construction was started on 31st March X2. That means last day of the year, and consequently no depreciation has been charged on it. The construction activities will continue to happen. It will take 2 years to complete and be available for use. So is this an item of property, plant and equipment? Answer is no, because it is not yet ready. It is a capital work in progress. It is a capital work in progress. Are we clear with this? Yes, are we clear? So coming to your PPE, I need to split it into 3 parts. One is PPE. This is the vehicles and the factory building. So 49, 87, 750. Then you are having the and the building. Then you have the CWIP, that is the factory premises, 20 lakh 1,600. And lastly, we are having investment property, that is 1548 150. 1548 150. All clear? Anybody has any doubts here? Clear. Okay, so let us proceed. So adjustment 4 is done. The composition of other current financial assets is as follows. Interest accrued on bank deposits represents a right to receive cash. So this is a financial asset. Prepaid expenses. Is it a financial asset or a non-financial asset? Prepaid expenses. Is it a financial asset or a non-financial asset? Non-financial asset. So this will be other current assets. Royalty receivable from dealers represents a right to receive cash under a contractual obligation, and therefore financial asset. So coming to your other current financial assets. Financial assets. 127, 370 is a financial asset. Prepaid cannot be financial asset because you will be getting the benefit of the expense in the future, not cash. That's right. That's right. Okay. So that takes care of adjustment 5. Adjustment 6. Current investments consist of securities held for trading carried at fair value through PL. So they have given FVTPL. Investments were purchased on 1st January at 55,000 and are shown at cost as at 31st March X2. The fair value of the said investments is rupees 60,000. So I have to do a fair valuation. So this is in respect of investments and this is adjustment number 6. Plus 5,000. They said it is 60,000. Plus 5,000. Okay. Trade payables and trade receivables are due within 12 months. So that means it is current assets and liabilities. There have been no changes in equity share capital during the year. This is for statement of changes in equity. You can prepare this. Entity has the intention to set off a deferred tax asset against a deferred tax liability as they relate to income taxes levied by the same tax authority, and the entity has a legally enforceable right to set off the taxes. Ind AS 12 चिपका दिया यहाँ पे, same authority, same governing body, and we intend to net settle. So therefore, adjustment 9, you have deferred tax asset and liability separately. So abhi net off kar do. So this is smaller, so isko nikal do. This comes to 2,20,700. This comes to 2,20,700. Are we clear with this? Yes. Anybody, any doubts? Any doubts? All clear? Okay. Other equity consists of retained earnings only. Opening balance of retained earnings was 21,25,975. Why this is given? Closing minus opening will give you the profit for the year, which is going to help you in preparing your statement of changes in equity. But be careful, that profit will be modified because of the additional finance cost 85,504, 5,000 on account of the fair valuation that we have done. Okay, so there will be an impact on that profit. Okay, so that change will be there. So this is useful for preparing your statement of changes in equity. No further dividend has been actually paid by the company during the year. हमको पता है नहीं दिया है dividend, so therefore only disclosure. Okay, no dividend adjustment. Okay. Assume that deferred tax impact, if any, on account of above adjustment is correctly calculated in financials. This is a polite way of saying ignore deferred tax. Okay. Being a finance and accounts manager, you are required to identify the errors and misstatements, if any, in the balance sheet of Master Creator Private Limited and prepare a corrected balance sheet with details on the face of the balance sheet. That is, no need to prepare notes to accounts after considering the additional information. Provide necessary explanations or workings for the treated items wherever necessary. Okay. All right. So, anybody has any doubts so far? No doubts. So, you could just, you want to prepare the balance sheet or we proceed with the further questions and you'll do this for homework? Because सारे adjustments तो हमने कर लिए. You would want me to do the balance sheet or you can do this for your homework. Okay, you'll prepare nothing, just give the totals what I have told you, bifurcations, presentation, and then you will be in a position to get the balance sheet correctly. Okay. Yeah, only one student has said they will prepare. What about the others? Others said saying, "Sir, आप बना दो." Okay, fair enough. So I leave this for homework. कुछ है नहीं, just you need to put the figures what I have already written here. That's it. That takes care of your question. Okay. Coming to some of the case studies which we had not done earlier. Okay. I had done the big case studies for you. The small case studies are left. So we'll quickly run through these case studies and then one big question and then we are done. Okay. This was a big question, which was very small actually. Obviously, you need to be giving the deferred tax effect for whatever points are there. Like adjustment one also will have a deferred tax implication because borrowings, we do it based on effective interest and fair valuation. Tax department does not recognize that. So borrowings could become one of the issues. And wherever you see a gap, it could be one of the issues. It could be one of the issues. Okay. But they also need to give you the deferred tax rate. If the rate is not given, then also you cannot assume any rate and do the deferred tax. Okay, you will have to be given the rate. Okay, please go through case study one. Please go through case study one. Okay. On 1st April 20X1, Star Limited has advanced a housing loan of 15 lakhs to one of its employees at an interest rate of 6% per annum, repayable in 5 equal annual installments, along with interest at each year end. Employee is not required to give any specific performance against this benefit. The market rate of a similar loan for housing finance by the banks is 10% per annum. The accountant of the company has recognized the staff loan in the balance sheet equivalent to the amount of housing loan disbursed, that is 15 lakhs. Interest income is recognized at the contracted rate, that is 90,000 for 6% of 15 lakhs. Analyze whether the above accounting treatment made by the accountant is in compliance with the relevant Ind AS. If not, advise the correct treatment of the housing loan, interest and other expenses in the financial statements of Star Limited for the year X1, X2, along with workings and applicable Ind AS. You are required to explain how the housing loan should be reflected in the Ind AS compliant balance sheet of Star Limited on 31st March 20x2. You have all the details available. I need you to get me the value of the liability on the date of disbursement of the loan. Okay, on the date of disbursement of the loan. Yes, quick. Yes. Did anybody trying? It's not a straightforward calculation. The loan is being repaid every year. So along with the interest, also the principal gets repaid every year. Okay, I got one answer, which is correct. So let us start. Relax each month. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . So 15 lakhs into 90%. This is how you will get by multiplying opening balance with the rate of interest. 90,000. Total cash inflow, discounting factor 10%. Yes, what about okay? I got another answer. Let us try now. 15 minus 3. So this comes to 12 lakhs into 6%, 72,000. 13 lakh 54,864 602 284. Whoever got something around this figure should be right. It depends on how many decimals you have taken, what is the rounding off you have done. All of that depends on that. Okay. So this is the value of the liability. So when I disburse the loan, obviously to bank, I am disbursing a loan worth 15 lakhs. Loan to employee will appear at how much? 13 lakh 54,864. What is the balancing figure? What is the balancing figure? What do I treat this as? 1,45,136. What do I treat this as? Employee benefit expense, that's right, but this is for a tenure of 5 years. You are giving this benefit for 5 years, and therefore it will be treated as a prepaid expense. Prepaid expense. It's not against any specific performance requirement. As long as he is there, this as long as this loan is there, this prepaid expense has to be amortized over the life of that loan. This has to be amortized over the life of the loan. That's right. It's a prepaid cost. Okay. So now coming to the next one, how do I present? So this is the first one. On the date of giving the loan, this is the entry that will be passed. That is initial recognition. That is your initial recognition. All right. So this is on 1st April 20x1. 1st April 20x1. All right. Now, they have also asked how it will be shown in the balance sheet, right? How it should be shown in the balance sheet for the year ended 31st March 20x2. Can somebody tell me how will this be presented in the balance sheet? I'll give you about 2 to 3 minutes to work it out and tell me how will it be presented in the balance sheet at 31st March 20x2. Amount, Shailesh. I don't need which category, that we obviously know. Okay. Amount. Okay. All right. I got one answer. Anybody else? Okay. That's also one answer which Mansha has given. Okay. Keep the answers flowing until I finish my working. Okay, fair enough. So how do I present? So many of you have given the answer 11 lakhs, 350, 324, 062, whatever it is, that will be shown as a financial asset, as a financial asset, a loan that is advanced. Okay. Your answer is partly right. Your answer is partly right. Suppose if this question had come, what value will you show in the balance sheet? And you said 11 lakh 350, whatever rounding of adjustments excluded, whatever is there, if you just write 11 lakhs, your answer is not going to be correct entirely. Okay. Reason being, you are expected to split it between the current portion and the non-current portion. So as on 31st March X2, this is your balance, no doubt. But out of this balance, 8,38,385 will be realized after a period of 1 year. And the difference between 11 lakh 350 and 8 lakh 38,385 will be realized within 12 months from the reporting date. So therefore, you need to do the split. Okay. So 11 lakh 350 में से non-current is 8,38,385. So my current portion is obviously going to be 838,385. 261,965. So in your current assets under the heading under the heading current assets, in that your financial assets, you will show 2,61,965. In non-current assets under financial assets, you will be showing 8,38,385. Are we clear with this? Yes, are we clear with this? Similarly, your prepaid employee cost, so your total prepaid expenses is 1,45,136. So 1 lakh prepaid expense, 1,45,136. Your current portion, what you are going to write off in the next 1 year, is going to be 145,136 divided by 5. So 29,027. And your non-current portion will be the balance 4 years. One lakh 16,000. Sorry, my bad. Minus 29, this would be written off. So 145, 136 minus 6, minus 87,080. This is going to be your presentation in the balance sheet. You will be showing prepaid current as 29,027 under other current assets, and under other non-current assets, you will be showing 87,082. So see, as on 31st March X2, you had 1,45,136 opening. Out of this, you would have already written off 29,027. So in the balance sheet, you would be having 1,60,109. So that is your prepaid expense as at 31st March 20x2. Now, this in the next 12 months, I will be writing off one installment of 29,027. So that will be shown as a current portion, and the balance will be shown as a non-current portion, which will be written off after a period of 12 months, which will be written off after a period of 12 months. So 87,082, we will be showing it as a non-current item. Are we clear with this? Yes, are we clear with this? Anybody has any doubt so far? Yeah. So when we talk about how do we present in the financial statements, then at that point of time, it must be clear that you need to do a current as well as a non-current presentation. Okay. So now if you look at the language of the question, they are saying how should the housing loan be presented in the financial statements. So you need to give the detailed explanation of Ind AS 109, measuring it at fair value. And after measuring it at fair value, you will measure it either at amortized cost or FVTPL. Loan is not at a market rate. So when you take it to the market rate, it will be at 10% and not the 6% rate. Current correct accounting treatment, you take this, pass the journal entry, take the difference to prepaid expenses and amortize on a straight line basis. And then the journal entries. 1st April, 31st March, and presentation in the financial statements. All right. So this gives you a complete picture of how actually the solution is to be presented. Are we clear with this? Yes, are we clear? Yeah. Okay. So coming to the next one, case study two. So case study one I have discussed. Coming to case study two, Pluto has purchased a manufacturing plant for 6 lakhs on 1st April X1, useful life being 10 years. On 30th September X3, that means after 2.5 years, Pluto temporarily stops using the manufacturing plant because demand has declined. So production has stopped on that machinery. However, the plant is maintained in a workable condition and it will be used in the future when the demand picks up. That means it is in a ready to use condition. Ready to use. Okay. The accountant of Pluto decided to treat the plant as held for sale until the demand picks up and accordingly measures the plant at lower of carrying amount and fair value less cost to sell. Also, the accountant has stopped charging the depreciation for the rest of the period considering the plant as held for sale. The fair value less cost to sell on 30th September X3 and 31st March X4 was 4 lakhs and 3.5 lakhs respectively. The accountant has performed the following workings. Carrying amount on initial classification as held for sale. Purchase price 6 lakh less 2.5 year depreciation, that is 1 lakh 50, so 4 lakh 50. Fair value less cost to sell is 4 lakhs, so the value will be lower of the above two, that is it will be 4 lakhs. Balance sheet extracts other current assets, assets classified as held for sale, 3 lakh 50,000. Okay, this is on March 20x4. This is on September. Analyze whether the accounting treatment made by the accountant is in compliance with Ind AS. If not, advise the correct treatment along with the necessary workings. Okay, what do you guys think? Tell me, is it correct to treat it as held for sale? Is the treatment correct to treat it as held for sale? That's right. What they have done is they have stopped production on the plant, number one. They have kept the plant in working condition because if demand picks up, they can use the plant immediately, number two. Number three, they have categorized it as held for sale when in fact their intention is not to sell but to use it when the demand picks up, number three. Number four, they have stopped the depreciation because they have treated it as held for sale, but actually it is not held for sale, and therefore the depreciation on that is the stopping of the depreciation on that plant is not correct. You will have to, compute the depreciation for the entire year. And therefore, whatever they have done by treating it as held for sale is entirely incorrect. We cannot do that. We'll have to say that is the first thing. So for this, you will have to explain what is the meaning of held for sale under Ind AS 105. So under 105, the criteria is you should have actively marketed the asset. It should be held for immediate sale. And then, you should have you should have done active efforts to engage the sale. Sale should be probable within 1 year. They have given those 5 criteria under Ind AS 105, which needs to be fulfilled. Okay. Efforts have been made to identify a buyer or a buyer is already there. Okay. All this data is not there in the question. Merely because demand is not there, they have shut the machine and now they want to say a held for sale. वो criteria ठीक नहीं है. So therefore, you have to say that this accordingly does not meet the definition of held for sale, and hence we are going to treat it as a normal asset that is in workable condition, not held for sale. So therefore, I will be depreciating it for the entire year. Are we okay with this? Yes. Are we okay? Yes. So you have to explain Ind AS 105 in detail. See, in any case study question, see, partly this is the way the syllabus is drafted. So probably, you have not seen these questions much. Okay. But institute is going towards that trend, which is very encouraging, obviously, because this is the future of your examination. Okay. So when you see a case study, see, we are inherently very good with numbers. Balance sheet बनाने आ जाओ, फट 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 आप balance sheet बना दोगे. You will do the balance sheet immediately and come out. They will ask you calculate the fair value of the loan as per Ind AS 109, 1, 2, 3, 4, 5, 6. All of you will do that answer immediately. You are given another question on solving, you will do it immediately. We are inherently born to solve problems. मतलब it is a trait that has come along with birth, because हमारा system ही ऐसा है that problem solution, problem solution, problem solution. But these type of questions which you are seeing, these are case-based studies. A mere solution, इसमें आप solution करोगे, your solution will get over in 5 lines. Your solution gets over in 5 lines. What you will do? You will take opening balance, depreciation for the full year, closing balance. So this is the first thing you will do. Second, fair value less cost to sell is given at 31st March X4. You will compare it with the carrying value. If there is a requirement for impairment, you will do the impairment. 5 to 6 lines, you will not complete you will not take more than that to complete the answer. This I will write and tell you people. But यहाँ पे the intention is not only to check your computational skills. The intention is to check your understanding of the standard. So here, when they are asking it is held for sale, you must ensure that you write those 5 important conditions that is mandatory for an asset to be categorized as held for sale under Ind AS 105. You have to mention those standards provisions in detail. If this question comes, it will be for anything between 6 to 8 marks. The issue with a 6 to 8 mark question is you cannot complete it in 5 lines and say that ये solution है, ऐसा होना चाहिए, ऐसा नहीं है, so what is done is incorrect. You cannot. You have to explain why what you have done is correct. For that, Ind AS 105 details have to be given. And that is the story with every case-based study that you are that you are going to approach for any subject that is there. You could have a case study based approach in financial reporting. You could have a case study approach in audit paper. You could have a case study approach in direct taxes, indirect taxes. Everywhere you could have a case study based approach. In a case study, it's not important only to look at it from the perspective of a solution. You have to give the provisions of the statute, the standard, whatever is there in this case, to ensure that you get the full marks. Because you are not only exhibiting your computational skills, you are also exhibiting your comprehension of the accounting standard in this case, or how effectively you can comprehend the statute. देखो, आपको एग्जामिनर को बताना पड़ेगा. You have to tell the examiner that yes, I am an expert in accounting standard, I am an expert in income tax, I am an expert in audit. How do you exhibit your expertise? You exhibit your expertise by commenting on the standard, by commenting on the provisions of the standard and how that has not been applied in the given case. That is the thing which sets you apart from the regular layman, and that is what will fetch you marks and guaranteed success in your paper. Okay, so don't just solve and come to the conclusion that the question was so simple, I did it in just 2 minutes. You should not do these questions in 2 minutes. You should take 10 minutes and do these questions, because it is testing your knowledge of Ind AS in totality. It's not testing your computational skills. In fact, you may go wrong in computation. You may make some clerical error in computation. At that point of time, it is the theory that you write which is going to carry you to a great extent in the way this question would be evaluated. Are we okay with this? Yes. So with that, let us come to the question per se. Yeah. So now you have the asset purchased at 6 lakhs. You will depreciate it for the entire year. You will depreciate it for the entire year. So now it would have fetched 3 years. So 6 lakh by 10 into 3 years. So this will be 1,80,000. So this will fall down to 4,20,000. This will fall to 4,20,000. Now the fair value at 31st March 20x4 is 3.5 lakh respectively. 3,50,000. So you are having an impairment loss of 70,000. If you stop again at 3 lakh, 4 lakh 20 minus 3 lakh 50, 70 and tell that this is your impairment loss, you are still missing one point. You are still missing one point. What are you missing? You are missing the definition of recoverable value under Ind AS 36. What is recoverable value? It is higher of fair value less cost to sell, which is 3,50,000, or value in use. Okay. So value in use will be 0 because the plant has temporarily not been used due to absence of demand. And this is 3,50,000. So therefore, higher of the two will be your recoverable value. So 3,50,000. Compare it with 4,20,000. You will then have an impairment loss of 70,000. So at each step, you need to explain the provision of the standard and then proceed further. ऐसे ही you cannot proceed to doing the question. ऐसे ही you cannot proceed to do the question. Are we clear with this? Yes. Case study 2 is understood. Yes. Anybody has any doubts? Case study 1, case study 2. Yeah. Any difficulties, girls and boys? So my sincere advice to you is, don't just focus on computational achievements. That will fetch you at best out of 100 about 50 to 55 marks. My advice to you is, okay, if you can think about it, if it makes sense. My advice to you is, this is the first paper of yours. Okay. This is the first This is the first paper that you have. Your first paper, you should hit a 6. Okay, if I just use the word, you should hit a 6 in this paper. It has a psychological impact on the other papers. See, if you hit a 6 in this, that means if you score at least, if you aim for at least 85 to 90 marks achievable in this paper, then what will happen is you go with a very positive psychological impact into the remaining two papers. That is your advanced financial management as well as your advanced auditing. So you are able to carry the success. You will be left with close to, assuming 60 is your exemption, never target 50. 60 should be your benchmark. With 60 as the exemption, if you aim for a target of 90, you carry a surplus of 30 marks to the remaining two papers. So you will be left with, even if you are targeting about 50 to 45 to 50 there, this 30 surplus marks is adequate for you to sail the group in the event of any unwanted situation. An AFM paper may be extremely tough. Advanced auditing may not be what you expected. So these 30 marks will carry you for clearing of the group. Fair enough? So you should target at least 85 to 90 marks scoring in the paper like financial reporting. It is doable because this being your first paper, you can allot at least a week to revision of only financial reporting. So when you go to the exam, you can easily ensure that the syllabus is completed, everything you know, you can go and write the answers. So don't focus only on computational excellence. Please ensure you are up to date with the provisions of the index. And that does not require you to read the entire index. Every index has particular core areas or particular gists. Like index 105, it talks about held for sale. It gives you criteria for held for sale. Though that para only is significant for you. If you talk about index 12, for example, it tells you what exactly do you mean by deferred tax. That para is of significance to you. So you basically need to know that what you are computing, you should be able to explain that in words effectively. So that is what you need to master for the purposes of your examination. Okay. So coming to in case study 2, a summary. First one, it is not held for sale because it does not meet the criteria of held for sale. It is an asset that is temporarily kept out of use, but it is in a workable condition. They have told in the question, it will be used when the order picks up. So therefore, you have just kept it ready for use. Even if it is kept ready for use, depreciation has to be charged. They have not charged depreciation, assuming it as held for sale. So that treatment is not correct. So you will be depreciating right up to 31st March 20x4, which amounts to an accumulated depreciation of 1,80,000. So your net value of the asset will be 4,20,000, the net carrying value as on 31st March 20x4. This is the first part. Second part, you are given fair value less cost to sell of 3,50,000. So since you are given fair value less cost to sell, we will have to do a check for impairment. Question will not tell you check for impairment. Idhar bhi kuch likha nahi. Have they told you? Just check whether it is in compliance with Ind AS. Now you are having carrying amount 4,20,000. You are having fair value less cost to sell 3,50,000. Automatically the trigger should come in your mind that if my fair value less cost to sell is 3,50,000, how can I have the asset at 4,20,000? So you have to talk about impairment. And when you talk about impairment, you have to ensure that you discuss what do you mean by recoverable amount. And in the recoverable amount definition, you will have to tell what is the value in use and what is the value in use, and along with that, what is your fair value less cost to sell. Fair value less cost to sell is higher, so 3,50,000. That you are comparing with 4 lakh 20 and giving an impairment charge of 70,000. Are we clear with this? Yes. So this is how you will present your answer. This is how you will present your answer. Okay. All right. Next. Next. Let us proceed to case study 3. Let us proceed to case study 3. On 5th April 20X2, a fire damaged the consignment of inventory at one of the Jupiter Limited's warehouses. Okay. This inventory had been manufactured prior to March X2, costing rupees 8 lakhs. NRV of the inventory prior to the damage was estimated at 9.6 lakhs. Because of the damage caused to the consignment of inventory, the company was required to spend an additional amount of 2 lakhs on repairing and repackaging of the inventory. The inventory was sold on 15 May 20X2 for proceeds of 9 lakhs. The accountant of Jupiter treats this event as an adjusting event and has adjusted this event of causing damage to the inventory in its financial statements and accordingly remeasures the inventories as follows. Cost is 8, net realizable value 7.6, inventories at lower of cost and net realizable value 7.6. Analyze whether the above accounting treatment is in compliance with Ind AS. If not, advise the correct treatment along with working for the sale. Okay? All right. Yeah, that's right. So tell me, is this, first of all, an adjusting event? A fire has occurred and damaged a consignment. The inventory had been manufactured at 8 lakhs. NRV was 9.6 lakhs. You need to do a further repair and repackaging cost of 2 lakhs. Inventory was sold on 15th May for 9 lakhs. Okay. So now tell me, what is the question on, first of all? Is it on inventory or is it on events occurring after the balance sheet date? Because सबसे पहले हमें वो समझना पड़ेगा. Events after the reporting period or inventory. What does the question pertain to in major? Okay, both. All right. Girls, Shruti, Namrata, क्या लगता है आपको? Tanisha, what do you think? Mohammed, what do you think? Viraj, what do you think? Satish, Mansha. Okay, all right, fine. The core thing is the employee has treated it as an adjusting event. So you have to explain what is Ind AS 10, what does it say constitutes an adjusting event, and then you have to compare it with the data given in the question and ask whether it is a uh, what you can say, whether it is an adjusting event. Okay, so the issue is Now, is it an adjusting event? I need you to answer, is it an adjusting event? Is it an adjusting event? सोच के जवाब दो. Think and answer. Is it an adjusting event? Okay. I got couple of answers saying it is an adjusting event. I got a couple of answers saying it is not an adjusting event. It cannot be an adjusting event. When did the fire take place? On 5th April. Year ending is 31st March. Was the fire existing on 31st March? Answer is no, it wasn't. For an adjusting event, the event should exist on the balance sheet date. The condition should exist on the balance sheet date. But sir, inventory was there on the balance sheet date. But आग नहीं था. There was no fire on 31st March X2. So as on 31st March X2, inventory was very happily sitting in the godown without any fire. Without any fire. Okay. So there is no fire whatsoever on 31st March X2. Sir, inventory was there. Inventory to hoga hi. Inventory is not an adjusting event. The existence of inventory is not an adjusting event. The existence of fire on 31st March 20X2 becomes an adjusting event. Did they say the fire is from 30th March till 5th April? Answer is no. 31st March, it becomes a non-adjusting event in this case. What? The fire that took place on 5th April 20X2 becomes a non-adjusting event. And because it is a non-adjusting event, there is no requirement for you to do any restatement or any adjustment. All that you need to check is on 31st March X2, the cost is 8 lakhs. The NRV is 9.6 lakhs. So your valuation of the inventory should be at lower of cost or NRV, that is 8 lakhs only. It cannot be 9.6. It cannot be 9.6. Are we clear with this? Yes. Are we clear? Yeah. Are we clear? Non-adjusting event. Inventory will continue at cost of 8 lakh because NRV is 9.6. Okay. Let's proceed. Anybody has any doubts here, boys and girls? Any doubts? All clear. Okay, fine. So coming to the last case study before your break, case study 4. On 1st April 20X1, Sun has acquired 100% shares of Earth for 30 lakhs. Sun has 3 cash generating units, A, B, and C, with fair value of 12 lakhs, 8 lakhs, and 4 lakhs respectively. Company recognizes goodwill of 6 lakhs that relates to CGU C only. So C ka value 4 lakhs and this also has goodwill. Okay. During the financial year X2, X3, the CFO of the company has a view that there is no requirement of any impairment testing for any CGU since their recoverable amount is comparatively higher than the carrying amount and believes that there is no indicator of impairment. Analyze whether the view adopted by the CFO of Sun Limited is in compliance of the Ind AS. If not, advise the correct treatment in accordance with relevant Ind AS. Okay. Tell me. If there is no indicator of impairment, should you test for impairment or you can ignore? Yeah. If there are no indicators of impairment, should I check for impairment? Impairment indicators means what? Product has gone obsolete, market is moving at a faster pace, etc. etc. Okay. Will you test for impairment? Answer is no. If there is no indicator of impairment, there is no need for you to do an impairment testing. There is one exception to this. The exception being, if goodwill is allocated to any cash generating unit, that CGU will be tested annually for impairment, regardless of whether indicators of impairment exist or not. Are you clear with this? You need to understand. If there are no indicators of impairment, no need to do impairment testing. But if goodwill is allocated to any cash generating unit, then that CGU needs to be tested annually for impairment, irrespective of whether indicators exist or not. So in this case, A and B need not be tested for impairment, but C has to be tested for impairment because goodwill is allocated to it, and therefore you will have to take the annual impairment into consideration for uh, you will have to take in consideration for the purpose of impairment. Is it okay? Yes. So goodwill का आपको एक बार impairment करना पड़ेगा. That is CGUC. Okay. So accordingly, impairment testing in respect of A and B are not required, but you test CGU irrespective of any indication of impairment annually, as the goodwill acquired on business combination is fully allocated to CGUC. Okay, so that takes care of illustration 4, case study 4. Okay, so that is done. That's it. There is no other requirement. Yes, there is no other requirement. So with that, we come to a close of all the case studies that we had lined up for discussion. Case study 7 was the last one. Then we had test your knowledge questions. So case study 7 was the last. We have done all the case studies. Okay. Now, with this, I give you a break. It's 8:30. Okay. We take a break right now, and after the break, we shall resume our discussion on question number 6. Question 6, slightly important. It is actually an Ind AS 101 question, and this Ind AS 101 question also deals with analysis. So therefore, it is clubbed here. So we will go through question number 6 after your break, and that's about the last question that we have. Okay. All right. Thanks. We take a 15-minute break. Okay. Break. So, yeah. So that takes care of your case studies that were there in the study material. All the case studies we have discussed. And apart from that, now we move on to the last question. That is actually an Ind AS 101 question. But they have placed it here. That is fine. They have said it is an analysis of financial statements. So we will also treat it as such and we proceed further. Okay. Okay. Fine. So come to question number 6. Him Limited, having a net worth of 250 crores, is required to adopt Ind AS from 1st April 20X2 in accordance with the company's Indian Accounting Standard Rules 2015. Rahul, the senior manager of Him Limited, has identified the following issues which need specific attention of the CFO so that the opening Ind AS balance sheet as on the date of transition can be prepared. Okay. All right. Now, we have done Ind AS 101. So all those issues you are aware of. We had covered about 9 issues specifically. A brief recap of those issues before we just come to this question. So Ind AS 101. The first major issue that we had discussed was employee stock options. So they were categorized into 3. One is vested and exercised. No impact on the Ind AS transition because the stock option outstanding account would have nullified by the time the transition is in place. Coming to the second case, vested but not exercised. Here, Ind AS gives you an option either to go for retrospective restatement or alternatively, Ind AS tells you that you can take the previous GAAP carrying value of the stock option outstanding reserve into the current year because no EBE is going to be booked further. Coming to the third case, you had your options where vesting is still pending. Here, you do not have the previous GAAP carrying value. You will have to restate to the, there is only one option, that is restatement. So you will have to go back, find out the fair value, and then you need to restate the stock option outstanding and then proceed to do the working. So this was the first thing that we saw, that is ESOPs. Coming to the next one, foreign exchange. In this, we had a para 4646A case, that is where basically the exchange difference on long-term foreign currency monetary items, the liabilities, you could either take it to the FCMI TDA account and amortize over the tenure of the loan, or if it was for procurement of fixed assets, you could capitalize it into the value of fixed assets and then depreciate it. Or this was option 2. Option 1 was always there that you could take it to the profit and loss account. So on transition, what is going to happen is if you were following option 1, you can continue option 1 only. If you are following option 2, that is FCMI TDA or capitalizing, you could continue that for the existing loan, and for fresh loan, you have to follow Ind AS 21. So option 2 to option 2 was permitted for existing loans. Option 2 to option 1 also was permitted, where you could say that I will stop capitalizing or amortizing and henceforth I will take it to the profit and loss account. That was also permitted. As far as FCTR was concerned, no previous cap carrying value was permitted because that was on the basis of integral, non-integral operations. So therefore, in the current regime, in the Ind AS regime, you could either do a retrospective restatement of FCTR or you will have to reset it to 0 and henceforth proceed to calculate the FCTR. Okay, so that is what we discussed under the foreign exchange. Coming to the third one, property, plant, equipment, intangible asset, investment in subsidiary, associate, joint venture in the separate financial statements. Either go for retrospective restatement or you could take a deemed cost. Deemed cost could be either previous cap carrying value or the fair value on the date of transition. When I say fair value on the date of transition, it need not necessarily mean that I'm following the revaluation model. It is merely a starting point for applicability of Ind AS. Thereafter, the question arises whether you want to follow the fair revaluation model or cost model, for which the treatment will be done in line with Ind AS 16 subsequently. Coming next to number 4, business combinations. As far as business combinations are concerned, you can identify a date after which all business combinations would have to be restated in line with Ind AS. That means you will have to consider fair valuation of assets. You will have to consider fair valuation of liabilities, measurement of PC as per Ind AS, measurement of NCI as per Ind AS, and consequently, the goodwill also will end up getting remeasured. So this is in respect of items of business combinations happening after a particular date that you have identified. If in respect of matters which are prior to the date selected for applicability of Ind AS, then you can continue as per the previous GAAP carrying value. Normally, entities do not touch any business combinations. They take the business combination date as the date of transition and proceed to do the transition. So that is case number 4. Case number 5, compound financial instruments. You are having convertible debentures. So what you will be doing is you will find out the liability and equity component right on the date of issue, retrospective restatement. Okay. And then amortized cost on the date of transition. And what is the previous GAAP value after adjusting for discount or premium amortization you will consider, and replace the equity component and the financial liability component in the place of the existing previous GAAP value. Difference will be taken to the retained earnings. So this is your compound financial instruments. Coming to investment in joint ventures, under Ind AS you have equity method, whereas under the previous GAAP it was proportionate consolidation. So you will remove all proportionate assets, liabilities, etc., which you have recorded, including the goodwill, and replace it with a single line item, investment in joint venture. Coming to government loan below the market rates, no fair value permitted. Go for prospective application, that is record the benefit or the liability as financial liability as per the previous GAAP value. Grant is not recognized. So henceforth you will do that. Or go for retrospective restatement. Original date of loan you restate, find out the grant value, do the amortization and record it on the date of transition. As far as measurement of financial instruments is concerned, no previous GAAP value is permitted. Either go for retrospective restatement, that is EIR on the date of issue, compute it retrospectively from the date of instrument and restate accordingly. If computing old EIR is impracticable, then you compute the EIR on the date of transition and move forward. But under any circumstances, previous GAAP value will not be permitted. As far as estimates are concerned, no benefit of hindsight is permitted. Whatever you had estimated will continue in the Ind AS regime also. So this was basically the conditions that we saw. Okay. Now the same data you just have to keep in mind for the purposes of this question. Okay. So I hope that a little bit of Ind AS 101 is refreshed in your memories. So with this, we shall now attend the question on Ind AS 101. So issue 1. As part of property, plant and equipment, company has elected to measure land at its fair value and wants to use this fair value as deemed cost on the date of transition. Is the entity permitted to do this? Answer is yes. Under property, plant, equipment, we saw that I could use either retrospective restatement or deemed cost. Deemed cost could be previous GAAP value or fair value on the date of transition. So we are going to go ahead with fair value on the date of transition. Is it permitted? Yes, it is permitted. Carrying value of land on the date of transition was 5 lakhs. The land was acquired for a consideration of 5 lakhs. Fair value of land as on the date of transition was 8 lakh rupees. So you will be passing the entry land account debit 3 lakhs to retained earnings or revaluation reserve or fair value reserve, whatever name you want to give, you can give, but that will go directly to the reserve. It will not be routed through the P&L. None of the transition adjustments will be routed through the P&L because you cannot make profit on transition. Okay, so it will be routed through reserves directly. It will not be routed through the P&L. Okay, coming to the next one. Under Ind AS, the company has designated mutual funds as investments at FVTPL. They are anyways done at that. The value of mutual fund as per the previous cap was 4 lakhs at cost. However, the fair value of mutual funds as on the date of transition was 5 lakhs. So what are you supposed to do? You are supposed to take the fair value on the date of transition. So fair value on date of transition is 5 lakhs. Previous gap value 4 lakhs. Upward restatement of 1 lakh. So therefore, you will take the entry mutual funds account debit to opening retained earnings 1 lakh rupees. Okay, investment in MF account debit to opening retained earnings 1 lakh. Okay, so issue 1 permitted adjustment in opening retained earnings. Issue 2 adjustment in opening retained earnings, upward revaluation. Okay, coming to the next one. Coming to the next one. Company had taken a loan from another entity. The loan carries an interest rate of 7% and it had incurred certain transaction cost while obtaining the same. It was carried at cost on its initial recognition. Principal amount is to be repaid in equal installments over the period of the loan with interest payable at each year end. The fair value of the loan on the date of transition is 1,80,000 as against the carrying amount of the loan, which is 2 lakhs. Fair value on the date of transition, that means this is Ind AS 109 value. And as against carrying amount of the loan means what? Previous gap. So you have to restate your liability at 1,80,000 as against 2 lakhs. So you will debit the loan 20,000 and credit opening retained earnings 20,000. Okay. So loan account debit to opening retained earnings 20,000. Fair enough? Yes. Anybody has any doubts in these 3 cases so far? Any doubts? Anyone? Anybody has any doubts? First 3 cases. Come on, guys. Tell me. All clear? Yes, Mohammed, Prashant, Satish, Tanisha, Namrata. All clear? Yes? All right. Fine. So issue 3 is also done. Issue 4. Company declared a dividend of 30,000 for the last financial year. On the date of transition, the declared dividend was already deducted by the accountant from reserves and dividend payable has been regrouped under provisions. The dividend was only declared by the board of directors, not approved in the annual general meeting of shareholders. Subsequently, it was ratified by the shareholders. So now what do you do with this? Dividend not approved because AGM is yet to happen. So what do I do with this? What do I do with this? Can I recognize proposed dividend first? Can I recognize proposed dividend? That is the first question. Disclosure only. Have they given effect to proposed dividend? Answer is yes. So that effect I have to reverse. So it has gone in provisions. So I have to remove it from provisions. So dividend payable account debit. And I will take it to retained earnings. I will take it to retained earnings. Amount is 30,000. Amount is 30,000 rupees. Okay. They have already given the effect, but on transition, I cannot give the effect. So therefore, add back to retained reserves and surplus. That's right. You guys are brilliant. Okay. All right. Coming to issue number 5. The company had acquired intangible assets being trademarks amounting to 2,50,000. The company assumes to have an indefinite life of these assets. Under AS 26, indefinite life means you have to amortize it over 10 years. Under Ind AS 38, indefinite life means you have to test annually for impairment. There is no requirement for amortization because you cannot really amortize. Life is only 10 years as against an indefinite. You cannot amortize because life is not known to you. Okay, life is not known. So you cannot amortize. You will have to impair it over a tenure of, you will have to impair it annually. You will have to impair it annually. Okay. So for that reason, they are not comparable. The fair value of the intangible assets on the date of transition was 3 lakhs. However, the company wants to carry the intangible assets at 2,50,000 only. Is it permitted to carry at 2,50,000? Is it permitted to carry at 2,50,000 or is it mandatory to go for restatement to fair value of 3 lakhs? Bolo. Is it mandatory for a fair valuation or can I continue with previous gap value? Not mandatory. You can continue under previous gap value. So allowed. And if I continue at previous gap value, no entry is going to come in the financials. That's it. Coming to issue 5 is done, 4 is done. Issue 6. After consideration of possible effects as per Ind AS, the deferred tax impact is computed as 25,000. This amount will further increase the portion of deferred tax liability. Okay, increase the portion of DTL. There is no requirement to carry out the separate calculation of deferred tax on account of Ind AS adjustments. Okay. Deferred tax, can I ignore or should I consider? Suraj, intangible assets, maximum life, 10 years assumption is under AS 26. Under Ind AS, it could either be the contracted life, which is there as per the contract terms, if it is something like trademarks or anything of that sort, streaming rights, for example, okay, they are contracted for a particular life period. So you will take that as the life. But intangible assets with indefinite life, there is no requirement of a maximum life because the life is indefinite, not infinite. It is indefinite. So indefinite means मुझे खुद को नहीं पता इसका life क्या है. So every year I will test it for impairment. AS 26 में indefinite life clause was there, but they said if intangibles have an indefinite life, amortize over 10 years. That is not there under Ind AS. Under Ind AS, if it is indefinite, amortize every year. You cannot test for impairment every year. You cannot amortize it because आपको life ही नहीं पता है. Okay, so that is the difference. Okay, I hope you are clear. Okay. Coming to issue 6, after consideration of possible effects as per Ind AS, deferred tax is computed as 25,000. So you should consider the deferred tax impact. So the entry for that will be retained earnings debit to deferred tax liability, 25. That's it. The management wants to know the impact of Ind AS in the financial statements of the company for its general understanding. Prepare Ind AS impact analysis report for him limited for presentation to the management, wherein you are required to discuss differences between earlier GAAP and Ind AS against each identified issue for preparation of the transition date balance sheet and also pass the journal entry for each issue. Journal entry to हमने कर दिया. Now, when it comes to the transition impact, you can just go through how they have done the presentation. It's not exactly what you can expect in the exam, but maybe out not 6, but you may get 2 cases where they require a comparison to कर सकते हो. Okay. So fair value as deemed cost for property, plant and equipment, they have given the journal entry also. So this is the same journal entry what we have taken. Coming to fair valuation of assets, you can take the impact. So this is the journal entry. Same thing what we have done. Borrowings, you can take it at 20,000, what we have done. Issue 3, see, issue 3, what they have said. Fair value of the loan is 1 lakh 80, carrying amount is 2 lakhs. What should you do? You should take it at 1 lakh 80. You cannot take previous gap carrying value. And because you cannot take previous gap carrying value, you have to restate it to fair value. Fair value is 1 lakh 80. Carrying amount is 2 lakhs. So the liability will be debited with 20,000 and retained earnings will be credited with 20,000. Okay. So that is issue 3. No problem with that. Okay. Fair value on the date of transition is 1 lakh 80 and book value is 2 lakhs. So accordingly, 20,000 adjusted through retained earnings. That's about it. Issue 4, proposed dividend, we have discussed. Provisions account debit to retained earnings. Same thing, no change. Intangible assets, no impact because we are continuing with the previous book value, previous gap value. Okay. There would be no impact on the date of transition since company intends to use the carrying amount instead of book value. Instead of fair value at the date of transition. ये थोड़ा printing mistake है. Instead of fair value at the date of transition. Okay. So that's it. Issue 5. And coming to issue 6, deferred tax. On the date of transition, DTL would be increased by 25,000. So we are increasing it by 25,000. So retained earnings to deferred tax liability, 25,000. So that completes in totality question number 6. Anybody has any doubts? I thought it would be a long question. ये तो 15-20 मिनट में ही खत्म हो गया. Okay. All right. Fine. Okay. So question number 6 also is done. Okay. Anybody has any doubts? See, this question most likely it will not come in this manner because previous gap, current transition, that unlikely will not come because your syllabus by itself is only Ind AS. Okay. Transition impacts will come, but that is rooted most of it to retained earnings. So I don't foresee a question coming like this. What is important is the journal entries on transition. So that will definitely be probably a part of your examination. Please follow that. Rare situation, you will get this. Please follow what is done. Okay. All right. Coming to the next one. Okay. So now, okay. So let us come to the other part. All right. Fine. Okay. So okay, so Manideep has a question. Intangible assets which company wants to take carrying amount of asset, is it not mandatory for a company for all assets to carry at their carrying amounts if they want to carry one asset at its carrying amount? Yes, definitely. So here we are talking about intangible. So you look at classes, tangible assets, intangible assets like that. Okay. So intangible you can take at carrying amount, tangible you can take at fair value. That could be the way you take it. Okay. Basically maintain consistency. There is no requirement that everything should be at transition value. वो तो हो नहीं सकता. Okay. You cannot have that. So for different class of assets, you can have different transition provisions that you want to take into consideration. Okay. All right. Okay, so I have received a request to explain question number 3. Okay, so हम करेंगे question number 3. Okay. Okay. Anything else? Any issue in question 6? Any other issues? Manideep, I hope it's clear. No other problems? Okay, fine. So let us come to question number 3 on request. Okay. Mercury Limited is an entity engaged in plantation and farming on a large scale, diversified across India. On 1st April 20x1, the company has received a government grant for 10 lakhs, subject to a condition that it will continue to engage in plantation of eucalyptus trees for a coming period of 5 years. Okay. So this is the criteria for the condition for the government grant is you will have to continue planting eucalyptus trees for a period of 5 years. तो वो हम करेंगे. Eucalyptus trees are not considered as bearer plants in this case. If you read the definition of property, plant and equipment, it includes bearer plants. It includes bearer plants. And if you read the definition of biological assets under Ind AS 41, it excludes bearer plants. Bearer plants are basically fruit-bearing plants, okay, produce bearing plants. So they are recognized as an asset under Ind AS 16. They are not classified as a biological asset under Ind AS 41. So bearer plants are covered in Ind AS 16 and other biological assets are covered under Ind AS 41. So by saying that eucalyptus trees are not a bearer plant, it is the biggest hint that says that in this case, do not look at Ind AS 16. Ind AS 41 will be applicable. Ind AS 41 that deals with agriculture will be applicable. The management has a reasonable assurance that the entity will comply with the condition of engaging in plantation of eucalyptus trees for a specific period of 5 years, and accordingly, it proportionately recognizes the grant for 2 lakhs in the statement of profit and loss as income following the principles laid down under Ind AS 20, accounting for government grants and disclosure of government assistance. Analyze whether the above accounting treatment made by the management is in compliance with the Ind AS. If not, advise the correct working of the same. See, Ind AS 20 deals with government grants. 10 lakhs is a government grant in this case. So if you look at the government grant, it is mandating you to continue planting eucalyptus trees for a period of 5 years. And eucalyptus tree is a biological asset governed by Ind AS 41. So basically, this government grant is having its relationship with Ind AS 41 and not with Ind AS 16. So now coming back to Ind AS 20, Ind AS 20 specifies the treatment of government grant except when it relates to an agricultural activity. So in this case, the government grant relates to an agricultural activity and therefore we cannot apply Ind AS 20, we will refer Ind AS 41. And Ind AS 41 tells us that, boss, you can recognize government grant as an income only when all the conditions related to the government grant are met. So in this case, you have received a grant of 10 lakhs or you are going to receive a grant of 10 lakhs. This 10 lakhs is subject to the condition that you will plant eucalyptus trees for 5 years. Ind AS 41 says recognize income only when all conditions are fulfilled. All conditions are fulfilled means 5 साल तक आपको eucalyptus trees plant karna hai. You have to continue planting eucalyptus trees for 5 years. That means what? That means you can recognize this government grant as an income only after a period of 5 years. Only after a period of 5 years. Until then, this government grant is going to remain as a non-current liability. As a non-current liability, it cannot be taken to income. It cannot be taken to income. Are we clear with this? Yes. Are we clear? Any? Yes, Prashant, did you follow? Yes. Yeah. No doubts. All clear? Okay. So that settles those questions. I had left these questions for homework. They are not so difficult. So once you try to solve, I think you will be able to complete this. Okay. So that kind of, concludes our discussion. Yes. So with that, yes, we are through with your syllabus. I don't think you have financial reporting any further, right? So this happens to be the last time you have attended FR, at least for this batch. Yes. So I hope there are no further doubts or any issues. Yes. I hope we have been able to clarify your doubts, your queries, and I hope that at least by now you have a good overview of the entire FR syllabus, a good understanding of the standards. At least now you should be in a position to interpret the questions and be able to answer solutions accordingly. Okay. So if there is anything else, you will have to let me know. If there is anything else, you will have to let me know. Okay. All right. Any other discussion, any other points, anything else you want, please ask. I can spare about 10 minutes. Yeah. Very nice to note that the sessions were useful. Okay. See, when I talk about MCQs, I think you will get case-based MCQs. Okay, so case-based MCQs could probably mean, you get a case and 3 to 4 MCQs related to that is what could be asked. Okay, you will not get Ind AS 21 is which of the standards. They'll give you 4 options. ऐसे questions नहीं आएंगे. Okay, so you will get questions which are case-based, and along with that, 3 to 4 questions will make one 3 to 4 MCQ questions will form part of one case study of one case, and you will have to compute and present the answers. उसमें से एक option आपको tick करना पड़ेगा. So that is your MCQ. Basically, it requires no different treatment. Your regular knowledge of the standard, your regular understanding and problem solving approach should take care of the MCQs. Okay. So that is the only thing in MCQs. Coming to coverage of the paper in the examination. See, if you ask me, the first 10-15 minutes, I think you get reading time, right? Don't wait outside the examination hall revising in the allotted reading time. जो आपने इतने टाइम नहीं पढ़ा है, you will not be able to read that in 15 minutes. So that you will not be going to achieve anything. But by taking these 15 minutes of reading time in the exam hall for reading the question paper, you can definitely identify which question is maximum, and which question is the easiest to score more marks for each one of you. It could be different. Somebody would have studied Ind AS 21 very well. Somebody would have done Ind AS 105 very well. I don't know. And they see a question. So advice is in those 15 minutes, you should be in a position to identify which are the highest scoring questions for you. And that is what you have to attempt first. That is what you have to attempt first. Going chronologically, किसी को impress मत करो, because important is you getting the first hour. The first hour, okay. I think your examination is at 2 p.m. So 2 to 3 p.m. should be spent in capturing 40 marks, scoring 40 marks, 40. 3 to 4 p.m. should be capturing another 30 marks, scoring wise. I'm not talking about attempting wise. So 40 plus 30. And after that, that is from 4 to 4:30 p.m., you should try to score another 15 to 20 marks. So that is how you should plan. If you are unable to gather 40 marks in 1 hour 15 minutes, it will be very difficult for you to complete the paper satisfactorily. And for that, the only solution to this is practice adequate question papers at home. What happens is students are aware of the solutions, but because of lack of time, they are unable to attempt it. I have seen many students who have often expressed this. Sir, FR paper is lengthy. FR paper khatam hi nahi hota hai. All that is true. I don't deny that. It has to be like that. It will be like that because content is so vast. You are able to see that, I don't know, this classes probably started somewhere in September or maybe before that also. Okay. For May 2024. We started way back in September. We have come prior to that, and we have now reached the end of February. So course is vast. You will be tested, and the paper will be huge. These are the few things you have to understand about FR. There is no point in crying about this. Accept it. It makes your life easy. So first 1 hour, 40 marks. Next 1 hour, 30 marks. Last half an hour, 15 to 20. First 40 marks should be guaranteed in the 1 hour. You should not leave any margin of error. Next 30 marks, you should ensure that you are at least 85 to 90% accurate. And coming to the last, you can look for experimenting. You don't know a solution, but you have a feeling that this could probably the way to approach. That point of time, you approach it. The last examination paper, what has happened was many students spent a lot of time on question 1 that was slightly unfamiliar, which came with bonus shares in consolidation. Thoda sa unfamiliar tha, but many students spent 1 hour, 1 hour 10 minutes, 1 hour 20 minutes, and then they panicked for the remaining. A consolidation question will come for at the most 20 marks is what I understand. Okay. You cannot afford 20 marks for 1.5 hours. That means you're left with 1.5 hours for 80 marks, and you will come back with a heavy baggage that your paper has not gone well. So therefore, my suggestion to you is don't break your head on questions where you are unsure, at least in the first 1 hour. Always aim for hitting the bullseye and ensure you attempt only those questions where you are absolutely sure. Absolutely sure means absolutely sure. You cannot afford to go wrong. And my experience with all of you is you will at least find 75 marks of the paper absolutely familiar. At least 75 marks. Okay. Finding 75 marks familiar means 2 to 2 or 15 minutes of your exam paper you will be absolutely familiar. Okay. Remaining 20 to 25 marks will be unfamiliar for all the candidates across India who are answering. Okay. For professional examiner, you cannot expect a textbook answer to be printed every time it comes. Okay. थोड़े से अलग questions होंगे, but that you leave it for the end. Only then you can succeed. If you are very stubborn in attempting those questions first, you are just putting the axe on your own feet. Okay, अपने पैर पे कुल्हाड़ी मार दो बस. Don't try to impress by saying मैं chronologically करूंगा, मैं neatly presentation करूंगी. All that is not required. Okay, clear handwriting. No need of even drawing lines and everything. There is no time for that. If you want to draw ledger accounts, fold the paper in half, draw the ledger accounts, put the dates. It hardly matters what line, what shading, weighting, and all. Don't do. Don't be an artist or an architect in the examination. You are a student, an account student. So please ensure that you maintain the dignity of an account student. Don't be architects in your examination hall. Okay. All right. So that is the most important, because what happens is many students are excited to present a nice answer sheet. तो पहले क्वेश्चन में all lines, columns, everything will come. Scale वेल लेके आते हैं, पेन पेंसिल सब कुछ. Okay. Some people go even to the point of underlining with black pen, writing with blue pen. पता नहीं क्या क्या है. Now the blue pen is gone, everything is black. Okay. So don't do all that. You are only wasting your time. Okay. All right. So now this is done. Two topics of theory which is added. Which are those two theory topics? One is professional ethics, right? And one is accounting and technology. Professional ethics I had only done with you. Professional ethics मैंने ही किया था आपके साथ. Coming to accounting and technology, two topics of theory which is newly added. Which are the two topics of theory बोल रही है. Conceptual framework I have done. In introduction to Ind AS would have been done. Rest are all Ind AS only. So only thing what is left is accounting and technology. I think you can self-study that. Oh, hardly, it's nothing great. Okay. Accounting and technology is just, I'll just run you through that. Let me just check. I have not downloaded that. Okay. Hope the screen is visible. Yeah. Attempt the MCQs first, no problem. सर पढ़ना कैसे है, पहले इंड एएस करना चाहिए या फिर सीएफएस करना है? और ऑब्वियसली डू द इंड एएस फर्स्ट, then you go for CFS, because what happens is likely possibility that there may be application of other Ind ASs in CFS. So complete all other Indian accounting standards. Last may you touch consolidated financial statements, but don't leave CFS. Plan in such a way that CFS is done thoroughly in your preparation time before going ahead for your examination. Okay. So yeah, accounting and technology. This is the one theory topic which is there. ये पढ़ लो, it is more of a general topic that is there, nothing special. Okay, nothing very special or difficult. You can read it. They have given all the treatments. Okay, automation के बारे में बात किया है. Okay, I have done accounting and technology. I don't think I have done accounting and technology. I have not done this. Otherwise होना चाहिए था वो. आदित्य, accounting and technology. No, I have done professional ethics. I have not done this. Okay. All right. So accounting and technology, you know most of it. Okay. Automation process, you are aware of it. Back end, what happens? Just a take through of what is actually automation. Then what are the challenges? Robotic process automation. They have given some examples. Okay. So you can just read it. It is kind of, keeping you abreast with what exactly is the updates in the current accounting scenarios. Okay. So that is one thing which you can just go through. Cyber security, IFCO FR, blockchain, this, that, everything is there. A very general and broad overview is given. You don't have to, spend a lot of time breaking your head on accounting and technology. Even if it comes, the weightage will not be much. You can surely write something and come in the examination. It's more generalized rather than specific. Okay. Please attempt MCQs first if you feel you're confident about them. Okay. Attempt those questions first which you are confident. It could be MCQ, it could be subjective. Any question you are not confident, please don't attempt that first. Okay. So that is why the reading time is extremely precious for you. Okay. All right. अकाउंटिंग आई थिंक वो किसी और ने लिया था, मैंने नहीं लिया है. ओके. इधर दिख ही नहीं रहा है. टेक्नोलॉजी. आई डोंट नो. ओके. Okay. ठीक है. So that takes care of everything. Anything else, guys? Nothing. So all the best. It was great. You have been the first batch under the new syllabus and the seventh batch, I think, of this institute's live coaching classes initiative by the Board of Studies. Yes. As with all the previous batches, you guys also have been very much interactive and very much supportive. Lot of patient hearing by you in all the sessions, and I hope that we could all of us meet your expectations that you had. We could clarify your doubts, approach your queries, and we could, make you familiar with these indices. Okay. I wish you all the best in your exams. And for anything, feel free to reach out to the institute. All materials, everything has been uploaded from my side also. Nothing is pending. This analysis of financial statements, I have taken it from the study mat itself. So there is nothing specific. Okay. Left for me to upload. वो आप खुद से कर लेना. For any this thing, any query, you can approach the institute's mail ID fr_final@icai.in. So your queries will be diverted to me, so then I can address them. And that's it. I don't have anything much to say. All the best, and I hope to see all of you qualifying in the month of June, July. Okay? All of you will qualify, no doubt. Okay? Yes. All the very best, everyone. Thank you. Mail ID, mail ID, mail ID. 1 second. fr_final@icai.in. Okay. So this is your mail ID. Please feel free to reach out with your queries on this. They will be directed to respective faculty who has taught you. Okay. All right. Fine. Thanks. Thank you. All the best. All the best. Thank you, everyone. ठीक है. Session done.